Okay, today let's discuss start by us discussing accounting for associates. That is IAS 28. IAS 28. Accounting for associates, IAS 28. Now, we say that associate is an investment where the parent company has, just a minute, please. Okay, let's proceed. Sorry for that. Sorry. Okay, we want to look at how to account for associate, and we say that in associate, the parent company owns between 49% to 20%. That is in associate. We have less than 50%, and we have more than 20%. Therefore, in associate, the parent company is the minority shareholder. The minority shareholder. Remember, in the previous class, we discussed what is the parent, what is the subsidiary, how to account for the subsidiary, how to account for NCI, how to account for goodwill. That was in our previous class, how to consolidate. And we said that to consolidate is just to add assets and liabilities. Now, for us to develop this concept, I'm talking about today associate. And we said that associate is where the parent company owns between 49% to 20%. Therefore, in associate, the parent is the minority shareholder. Because if I own 49, there is somebody else who owns 51. Somebody else who owns 51%. Therefore, in that regard, we are the minority shareholder. We are the minority shareholder. Therefore, when we talk of associate is not the full group member. This associate, because we are the minority shareholder, is not full group member. Full group member. Associate is not a full group member. A full group member. Therefore, in associate, we don't control that company. Because it's not a full group member, we don't control that company. But we exercise what we call significant influence. In associate, we have what we call significant influence. Significant influence. What is significant influence? Significant influence is the power to participate in financial and operating activities of another company. Significant influence is the power to participate in financial and operating activities of another entity. Thereby, just participate in the decisions of that company, but I don't control, I don't make decisions for that company. I just participate in decision making. I just participate in financial decisions. I just participate in operating activities, but I don't control that associate. What are the indicators of significant influence? Indicators of significant influence. Don't struggle to write because these things are in the notes. I just shared the handout that we have been using. I just shared this evening When you check on our platform, I just shared that handout. All these notes are there. Don't struggle writing. Just listen, read notes, but don't struggle writing. Say, repeat, I want to write. No. Those notes that I'm explaining are already in the notes. Even what is significant influence is already in the notes I just shared. Therefore, after this, we make your own fine notes. Therefore, don't struggle. Amarim is just saying, don't struggle writing so that you start, Amarim will repeat. No. Therefore, we are saying significant influence is the power to participate in financial and operating activities of an entity. What are the indicators of significant influence? Number one, if you are asked, number one is supply of key raw materials. Supply of key raw materials. Therefore, I can supply key raw material to this company because I have what we call significant influence. Number two, provision of essential information. Provision of essential information. Essential information in that associate. I can give them essential information. Then also number three, giving them technical personnel, assisting with technical personnel. Technical personnel, I can assist on technical personnel there. Number four, significant influence, that indicators of significant influence is participation in decision making. We can say we can participate in decision making. We just participate in decision making, e.g. dividend policy. E.g. dividend policy, we can decide how much to be paid in terms of dividend because we have what we call significant influence. Therefore, these are the indicators of significant influence in the associate. Now, because I said that associate is not a full group member. Associate is not a full group member. Therefore, because associate is not a full group member, assets and liabilities, should not be consolidated. Assets and liabilities should not. Remember, Marimu is writing in bold that assets and liabilities should not be consolidated. Assets and liabilities should not be consolidated. Therefore, what Marimu is saying, because associate is not the full group member, we are just minority shareholders there. We do not consolidate assets and liabilities. The same way we were consolidating a subsidiary, like if I have, for example, PPE, we were taking H plus S. If H is 200, S is 300, therefore total is 500. Total is 500 there. Assets and liabilities of this associate should not be consolidated. Therefore, if I have three companies, I have H, S, and L. These are separate financial statements. PPE, this is 200, 300, 100. Therefore, this one I ignore. I don't consolidate assets and liabilities of an associate. According to IAS 28, investment in associate, according to IAS 28, associates are recognized, are accounted for using what we call equity method. According to IAS 28, associates are accounted for using the equity method. Using equity method. Malim is writing equity method on the board. We account associates using equity method, whereby associates are recognized at cost. Where associates are recognized at cost, associates are recognized at cost. And when we talk of the cost, this is cost of investment. Cost of investment. Associates are recognized at cost, which is the cost of investment. Associates are recognized at cost, which is the cost of investment, adjusted by post-acquisition profits and reserves, post-acquisition profits and reserves. Associates are recognized at cost. How do we recognize associate? If we say here investment in associate, investment in associate, investment in associate, investment in associate, we are saying that associates will be recognized at cost, thereafter adjusted by post-acquisition profits and reserves. When we talk of post-acquisition profits, I believe I already explained what are the post-acquisition profits. And I said that post-acquisition profits, these are the profits after acquiring a company. Profits after acquiring the company. Therefore, how do we get investment in associate? We are going to take cost of investment. How much? That cost of investment is the purchase consideration. That is the purchase consideration. Then we add group share of post-acquisition profit or reserves, post-acquisition profits or reserves. I come to add, then I less impairment loss in that associate, impairment loss, if it is there in that associate. I also less what we call unrealized profit, unrealized profit on closing stock, on closing stock, unrealized profit on closing stock. Then I get what we call investment in associate, investment in associate. That is how we recognize associate in our group financial statement. Therefore, this investment in associate, we are going to recognize it as a non-current asset in the balance sheet. Therefore, we put that as and say, investment in associate is recognized as a non-current asset in the balance sheet, where we recognize PPE, goodwill, intangible assets. We have investment in associate. Therefore, investment in associate is recognized as a non-current asset in the balance sheet, as a non-current asset in the balance sheet. That is how we recognize associate, but bottom line is assets and liabilities should not be consolidated. Any question on associate? Any question on associate? Any question on associate? Bottom line, we have said that assets and liabilities should not be consolidated. That is the bottom line, Therefore, if there is no question on associate, we go what we call joint arrangements. We go to what we call joint arrangements, If there is no question in associate, we go to what we call joint arrangements. IFRS 11 joint arrangements. IFRS 11 joint arrangements. Joint arrangements, that is IFRS what? 11. IFRS 11 joint arrangement. Now, when we talk of joint arrangement, those who are joining, I said that whatever we are discussing here, already the notes, you have them in the handout I shared on our WhatsApp. Therefore, you don't have to struggle writing. You don't have to struggle writing. You can just make your brief notes, but don't struggle too much writing. Therefore, when we talk of joint arrangements, this is an arrangement of which two or more parties have joint control. This is an arrangement whereby two or more parties have joint control. Like in a joint arrangement, we might have 50%, another one has 50%. Therefore, this is a joint what? Arrangement. Joint arrangement, I have 50%, you have 50%, therefore we co-share this company. That is what we call the joint arrangement. Now, in a joint arrangement, there are two types of joint arrangement. There are two types of joint arrangement. Number one, we have what we call joint operation. Joint operation. Number two, we have what we call joint venture. Joint operation and joint venture. A button on the meaning of joint arrangement. I say this is an arrangement of which two or more parties have joint control. Two or more parties have joint control. That is the meaning of joint arrangement, where two or more parties have joint control. And there are two types of joint arrangement. Number one is joint operation. Number two is joint venture. Joint venture. Now, when we talk of joint, let's start with joint operation. Joint operation. Joint operation. Joint operation. Joint operation, this is an arrangement whereby the parties that have joint control of the arrangement have the rights. This is an arrangement whereby parties that have joint control of the arrangement have the rights to the assets and obligation for liabilities. Have the rights on assets and obligation for liabilities. Have the rights on assets and obligation for liabilities. Therefore, in a joint operation, I have the right to assets and liabilities, expenses, revenues. I have the right. If I own 50%, therefore it means that in that balance sheet of the joint arrangement, I have 50% assets, 50% revenues, 50% expenses, 50% liabilities. I have the right to the asset and obligation for liabilities. Therefore, in a joint operation, the joint operator has the right to the number one, asset, number two, liabilities, number three, revenues, number four, expenses. I have the right to those items. If it is 50%, I have the 50% right. That is joint operation. I have the right to the assets. Therefore, listen to this, it's very careful. Listen to this very carefully. If it is a joint operation, the joint operator will consolidate his 50%. If it is a joint operation, the joint operator will have to consolidate. To consolidate means we are going to add assets and liabilities. We'll have to consolidate his share of assets, of liabilities, of anything in that company. You are going to consolidate 50% if it is a joint operation. Let's look at joint venture. Joint venture. Now, in a joint venture, the venturer has the right to the net asset of that arrangement. You have the right to the net asset of that arrangement, and that in net assets, you account for it as an investment. Listen very carefully the difference. In a joint venture, the venturer has the right to the net assets of the arrangement and shall account for that net assets as an investment. As an investment. As an investment. You have the right to the net assets of the arrangement, and you will account for that investment, net assets, as an investment. As an investment. I believe you are seeing the difference. In joint operation, let me repeat, I said the operator has the right to the assets and liabilities, expenses, revenues. You have the right to your share. But when we come to the joint venture, the venturer has only the right to the net asset, and you account for that net asset as an investment. As an investment. Therefore, it means in a joint venture, we account joint venture using what we call equity method. Joint venture is accounted for using equity method, using equity method. Equity method, joint venture will be accounted for using what we call equity method, whereby we are going to recognize the joint venture at cost, the same way associate, the same way associate. We are going to account for the joint venture at cost. Thereafter, we adjust it with post-acquisition profits and reserves, less impairment loss, less unrealized profit in joint venture. Therefore, let's see how we account for joint venture. How we account for joint venture. Therefore, if it's a joint venture, we said that we are going to account for it using equity method. Equity method, the same equity method used in IAS 28, equity method, whereby we recognize joint venture at cost. What is the cost? Cost of investment. Therefore, if I want to get investment in joint venture, I'm going to take cost of investment. Cost of investment. I come to add group share of costs, acquisition, profits and reserves. Profits and reserves. I come to less impairment loss. I come to less impairment loss. I also come to less unrealized profit on closing stock. And that item we are going to discuss it. UPS and realized profit on closing stock. We are going to discuss it just in a few minutes. I get investment in joint venture. Investment in joint venture. I get investment in joint venture. Then, investment in joint venture is recognized as a non-current asset in the balance sheet. Please listen. Investment in joint venture is recognized as a non-current asset in the balance sheet. Then we are going to account it the same way we account associate, the same way we account associate. We recognize associate is the same way we account joint venture. But if it's a joint operation, we are going to consolidate the 50% of our share. If it is PPE, I take 50%. If it is inventory, I take 50%. If it is what, I take 50% in that order. Now, I'm putting an exclaimer. Listen, this is where you need to listen kindly. Florence, this is where you need to listen very carefully. What I'm saying is that in a joint venture, in a joint arrangement, IFRS 11 favors the joint. Just a minute, kindly, just a minute. Sorry. We are back. Sorry for the inconvenience. It's just an issue there. Okay, I was saying that according to IFRS 11, it favors joint ventures. IFRS 11 favors what we call joint ventures. I said we have two: joint operation, joint venture. Therefore, if the examiner has brought a joint arrangement, kindly consider it as joint venture. You recognize it as joint venture unless examiner is categorical that it was a joint operation. But if the examiner is silent, kindly, Mwalimu is saying kindly, you use what we call joint venture, where you recognize this joint venture at cost, you adjust by post-acquisition profits and reserves. Are we together there? Kindly tell Mwalimu if you are together there. Kindly tell Mwalimu if you are together there, because it's very technical at that point. Tell Mwalimu if you are together there. Thank you very much, Ruth. Thank you. Florence, you say no. Where are we not together, Florence? Where are we not together? You can mute and say, where are we not together?
Oh, Mwalimu, good evening. Sorry.
Yes.
I'm not understanding the statement that you've just stated that if the examiner brought joint arrangement,
Yes.
I should consider it as a joint venture.
Venture, yes.
Yes, not unless the examiner is categorical, then that is where I lost you completely. I always have a network issue.
Oh, I was saying if the examiner is silent, then you are going to consider it as a joint venture. But if examiner insists that it was a joint operation, then it means you are going to consolidate 50% of everything. 50% of everything, you consolidate. But if the examiner is silent or tells you that it was a joint venture, then you only recognize this item as above in the balance sheet as an uncurrent asset. That is if the examiner is silent. Don't consolidate because IFRS 11 favors joint venture. Remember previously we were using IAS 31, where we were using what we call proportionate method. Proportionate method, where in proportionate method, we were taking 50% of everything. We are doing joint operation. In IAS 31, we were using proportionate method where we take 50% of everything. But when they changed the standard in 2013, they introduced joint ventures, and IFRS 11 favors that joint venture. That's why they shifted from IAS 31 to IFRS 11 to favor the joint venture. Therefore, that is why I'm telling you that examiner will bring this, but in most cases, according to IFRS 11, you are going to account for it as a joint venture. That is what Malim was saying. Thank you very much.
Thanks, understood.
Thank you very much. Now, that is all about associates and joint ventures. Associate and joint ventures. Now, before we go far, I want to discuss something. I want to discuss something also very technical. I want to discuss something very technical called control. Control. Remember, I said this is introduction, therefore you must be attentive to introduction so that when we shall be doing these things, you will not float. Otherwise, you may end up floating when we do some things, or the examiner wants you to do this, but you do your own things because you did not understand the introduction part. Now, we want to discuss control. Control. We just said that in associate, we exercise what we call significant influence. In associate, we exercise what we call significant influence, which means that in associate, we don't consolidate because we only have what we call significant influence. But in the subsidiary, we are going to control. Remember, in the subsidiary, we said you have 51% to 100%. Therefore, you have control of that company. You are going to do what? To consolidate because you have control in that company. Now, what Malimu is saying, we want to discuss what we mean by control. What we mean by control. Now, control is, we can say that control is the power to govern the financial and operating activities of another entity. Control is to govern or to control, govern operating and financial and operating activities. Financial and operating activities of another entity. Control is the power to govern the financial and operating activities of another entity. Now, when we talk of control, indicators of control or ways in which control can be exercised. 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 Remember, if I have control, then I consolidate. The moment I have control, then I consolidate. Therefore, ways in which control can be exercised. Number one, where the parent has more than 50% shareholding. Control can be exercised where we have more than 50%. Like if I have 51% to 100, I have control of that company, thereby I consolidate. Therefore, shareholding will give us control. Number two, where the parent has more than 50% voting rights. Voting rights. I have more than 50% voting rights. Kupiga kura, voting rights. I have more than 50% voting rights. 50% voting rights, then I will do what? I will consolidate that company. Like, for example, I can have shareholding 40%. My shareholding is 40%. Listen to this because it's very technical. Listen very carefully. It's very technical. I might have shareholding 40%, but the examiner tells you that when we come in terms of voting rights, I have 60% voting rights. I have 60% voting rights, but shareholding is 40%. It means it's an associate. But when we come to voting rights, I have 60%. Therefore, in that case, I still have control of that company. Therefore, I consolidate. Still, I will consolidate because by virtue of voting rights, I have 60%. Therefore, those are the things you need to listen to in an exam, in a question. I might have 40% shareholding, yes. You think it's an associate. You are very right. But when it comes to the next statement, examiner tells you that H Limited had 60% voting rights in A Limited. Therefore, it means that statement changes everything. That statement changes everything. It means I'm going to consolidate that company because by way of voting rights, I have more decisions there. Then another one is that the parent has more than 50% decision making. More than 50% decision making. More than 50% decision making. I have more than 50% decision making. I make most of the decisions of that company. I have 60%, more than 50% decision making, voting rights. Then even if shareholding is 40%, but when it comes to decision making, I have more. I can see Meshach, you raised the hand. Kindly, Meshach, you can air out your issues. I have not muted you.
Thank you. I had a question.
Yes.
When you said that you can have like 40% shareholding, but 60% voting rights.
Yes.
That one, you don't treat it as an associate. So, but when you are doing consolidation, which percentage are you going to use as share of the shareholding to the subsidiary?
Now, remember, when you are consolidating, you take it 100%. If it is assets, 100%. If it is liabilities, 100%. If it is revenues, 100%. But when it comes to profit in that company, you take 60, you take 40%. If it is, for example, I want to take the group share of the profit, I will take 40%. The profit, group share of the profit, I will take 40%. But I'm going to consolidate 100%. Remember, when you are consolidating, you take percentages. You don't take percentages when you are consolidating. You consolidate 100%. Therefore, the only thing that will be affected is like, for example, when it comes to in terms of profits. In terms of profits, I'm going to take 40% there in terms of profits. But the rest is 100%. The rest is 100%. Assets, liabilities, revenues, expenses, you consolidate 100%. Therefore, that is about decision making and voting rights. Then we have the next is that the parent, when the parent has the power, that is number 4. Number 4, when the parent has the power to govern financial and operating activities of the other company by statute. That is legal means. Legal means. By law, the law has allowed me to govern. The law has allowed me to govern, even though I have 40% or 50%, but by statute, the law has allowed me that I govern financial and operating activities. Therefore, I'm going to consolidate. A good example is, for example, it's a multinational company. In a multinational company, maybe we have a lot of experience in that area. We have a lot of expertise in that area of business, and we own 40% in the company. Then the law, Kenyan law, for example, allows us that although you have 40%, but govern this company because of the experience, because of the expertise, then by statute, if the statute has allowed us, then we are, I said the parent has the power to govern, to control, that is to govern the financial and operating activities. The parent has the power to govern or control the financial and operating activities of another entity. Therefore, those are some of the indicators or ways in which control can be exercised. Therefore, when we are talking of control, you don't only look at the ordinary share capital, because we said if you have more than 50%, it's almost a subsidiary. If you have less than 50%, it's associate, you don't consolidate. Therefore, somebody like my good friend Francisca, for example, she will only concentrate on the ordinary share. I have 40%. Therefore, I'm not going to consolidate. No, when you are reading the question, just confirm a lot of items that Mwalimu is saying. Although I have 40%, but do I have any factor that can make me control this company? Because examiner, those are the things that he will always test you. Do I have any other way of control that will help me either consolidate or not? Therefore, that is the way in which control can be exercised. Therefore, that is when we say control, that is what we mean by control. It's not only ordinary share capital. Although ordinary share capital is more of open, because examiner will tell you that we have this, we have that, but we have other ways that the examiner will hide inside that make you fail the question. Like it was, I think it was in 2023 or 2022, 2023. 2023, I think, was it August or 2022 December, where the examiner brought, we have 50% shareholding, 50% shareholding, but also he says that we have 60% decision making, 60% decision making. Therefore, because many people just knew that if it is 50% is a joint venture and you don't consolidate, they ignore it, they ignore that company. And that made many people to fail that question because they ignored to consolidate the 50%. But because examiner put that we had 60% decision, made most of the decision at 60%. Therefore, those who are reading the question when you are marking, you find that they ignore this one because they know very well, like my good friend Florence knows very well that Mwalimu said, if it is 50% joint venture, don't consolidate. Therefore, the mind is just saying like that. But now examiner has added another statement that says the H Limited also control 60% voting rights. Any question?
Mwalimu.
Yes.
Yes, Mwalimu, thank you for mentioning my name because you knew I had a question to ask you on that note that you're explaining. So if it is 50% joint venture and 60% decision making, how am I going to consolidate the revenue, expenses, assets, and the liabilities? Is it going to be 50-50 or I do not consolidate?
If it is 50% shareholding, but 60% voting rights or decision making, you consolidate 100%. You don't take the percentage kindly, Florence, when you are consolidating, you take 100%. That one, I believe we have been talking about it. Consolidation, you are not going to take the percentage, you take 100%. You consolidate as if you acquired 100%.
Oh, so if asset for H Limited is 60 and this S limited is 50, I take 60 plus 50.
Yes, that is how to consolidate.
Okay, so is that one for parent, associate, a subsidiary, or that is a joint venture, Mwalimu? Because there you
Now,
mentioned
what I'm saying, Florence, what I'm saying is, if it is purely a joint venture, if it is purely a joint venture, there is no other forms of control. There is no 60% rights, anything. Then you don't consolidate. If it is purely 50% or purely 40%, you don't consolidate anything. That one I already said. If it is purely 50%, examiner is very quiet. He said H limited on 50% in a J limited. Then it is quiet like that. It means this one you will not consolidate. That one I said. If we own 40% purely, 40% purely, then you don't consolidate. You leave it, you ignore. I have H, I have S, I have N, I have J. This one is their balance sheet. And this one is 40%, this one is 50%. There is no any other form of control. You ignore. You don't put them in your financial statement. You only consolidate parent and subsidiary Florence. But if examiner has challenged us with other form of control 60%, for example, in A, although I have 40%, but he has said I make 60% decision. Then when I'm consolidating, this is 60, this is 50, this is 30 asset. I will take 60 plus 50 plus 30 Florence. I get, that is 110. I consolidate if it is 40%, but when we come to other forms of control, examiner has told me that I own 60% decisions, for example. But if it is purely 50%, purely 40%, don't consolidate. I will not repeat that. I will move to the next item.
Thank you, Mwalimu. Understood.
Thank you. Okay, now let's move to the next item. Now we know what is control, and it will not challenge us in an exam. It will not challenge us in an exam because we know it. Let's look at something small called balance sheet, other balance sheet adjustments. 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 Balance sheet adjustment. Now, as we said, that if we have a subsidiary, we are going to consolidate if we have a subsidiary. Like, for example, I have a H, I have S. This is PPE, 60, 50. It means that in the balance sheet, I will take 60 plus 50, I get 110. That is to consolidate. I'm going to do what? To consolidate. I'm going to consolidate. Now, we have other items, transactions, that may have taken place during the year that IFRS 10 will not allow us to consolidate those items. We have some transactions that might have happened during the year, for example. Then when we are consolidating the assets, I'm not required to consolidate those transactions. That is what we are saying, balance sheet adjustments. And we are starting with number one, balance sheet adjustments number one, balance sheet adjustment number one. We call it intercompany owing, intercompany owings or debts, intercompany owings or debts. Don't struggle to write kindly. I already said that we have the notes in the handout. You will make your own notes because it's there. We are just want to explain so that we move faster. Therefore, intercompany owings. Intercompany owings is where one group member owes some amount to another group member. One group member owes some amount to another group member. Like, for example, I have H. H gives a loan. Let me write the word gives a loan to S Limited. H has given a loan to S Limited. Therefore, to H, it says I need to receive my money. To S, it says I need to pay the loan. I need to pay. To this one, I need to receive. That one, I need to pay. Therefore, that one is what we are calling intercompany debts or intercompany owings. Therefore, to H, it is a receivable. It has included as part of receivable. You understand, if you have given out your goods, you expect to receive. Then to S, which received the money or the goods, it says I need to pay. I need to pay. Therefore, we call it intercompany owings. Now, when we are consolidating, intercompany owings will be eliminated from the receivable and payable. Eliminate from receivable and payables. Receivable and payables. How do you eliminate? For example, I want to consolidate my receivable. I will take the receivable of H plus the receivable of S minus intercompany owing. Minus intercompany owing there. Then when I come to payable, I will take the payable of H plus the payable of S minus intercompany owing. I eliminate them from the receivable and the payable. Therefore, what Marim is saying that intercompany owings don't, and I repeat, don't consolidate, you eliminate from the receivable and from the payable. I believe that one we have understood, it has no problem. But let me explain something. Sometimes intercompany debts or intercompany owings might not be the same. Sometimes it might not be the same due to items in transit. Sometimes intercompany owings or intercompany debts may not be the same due to items in transit. Like, for example, let me give you an example here. H gave shillings 50 million to S. It gave shillings 50 million to S. But during the year, S has sent some 20 million. S has sent some 20 million to H. But H has not received this money. Therefore, it means that in the books of S, it is reporting 50 minus 20. It is reporting that as payable because it has already sent a check. It has already sent the check. But because H has not received this 20, it is still reporting 50. Therefore, intercompany owings is not equal in the books. In the books of H, it is reporting 50. In the books of S, it is reporting 30. But it is this because there is some amount in transit. There is some amount in transit that S has sent. Therefore, we call it cash in transit. Cash in transit. We call it cash in transit. Therefore, items in transit will be adjusted by subtracting from the receivable and creating what we call a cash in transit account. Let me repeat. Cash in transit will be adjusted by eliminating it from the receivable and creating what we call a cash in transit account. Therefore, let me show you how I can consolidate in this case. How I can consolidate in this case. How I can consolidate in this case. Listen very carefully. Receivable. I want to consolidate receivable. I will take the one for H plus the one for S, then I less 50. I less total amount of 50. Total amount of 50. Then in the payable, I will take the one for H plus S minus 30. I will not less 50 because the paying company is only remaining with 30. Then the difference of the cash in transit, I create what we call cash in transit account, cash in transit of 20. I create what we call cash in transit of 20. That is how we adjust cash in transit. If I have cash or bank balance, I add the cash in transit. For example, I have bank balance. That bank balance, I will add 20 to the bank balance or cash and cash equivalent. I will add this 20. Or if I so wish, I just report what we call cash in transit account. I disclose and report cash in transit account. Therefore, intercompany owings, bottom line, we eliminate from the receivable and from the payable. But if it is not equal to items in transit, the high amount eliminate from the receivable, the low amount eliminate from the payable, the difference create a cash in transit account. Create a cash in transit account. That is item number 1, intercompany debts or intercompany owings. Number 2 item is unrealized profit on closing stock. Unrealized profit on closing stock. Unrealized profit on closing stock. We shall be calling it UPS. UPS, unrealized profit on closing stock. Now, before we do unrealized profit on closing stock, let's have a break of 5 minutes, good friends. Let's just have a break of 5 minutes. You take some water, you refreshen up, then you come back, because these are very good items that I want you to understand. Now, let's continue with what we call unrealized profit on closing stock. Now, unrealized profit is where one group member will sell goods to another group member at a profit or loss. Intercompany owing, unrealized profit on closing stock is where one group member will sell goods to another group member for resale at a profit. For resale at a profit. Like, for example, H Limited sells goods to S Limited for Kenya shillings 500, making the profit of 50. Or let me say, making the profit of 100 million. 100 million. Therefore, it means that the goods to H, it was 400. It added the profit of 100 so that we made the sale of 500. The cost was 400. We added 100 million profit. The sale was 500. Therefore, we made the profit of 100. Now, it comes out that this goods has not been sold by the purchasing company. The goods has not been sold by the purchasing company, which means they are still in the inventory. Are you seeing what Marim is saying? The goods are still in the inventory. The goods are still in the inventory. Therefore, if the goods are still in the inventory, it means that we have not realized this profit, because that profit will only be realized when the goods have been sold by S. The purchasing company has sold to outsiders. Outsiders. Those goods have been sold to outsiders by the purchasing company. That is when we say we have realized the profit. But if the goods are still in the inventory, then it means that we have not realized the profit. That is why we call it unrealized profit on closing stock. Therefore, if there is an unrealized profit, you eliminate. Unrealized profit will be eliminated. That is the UPS. UPS will be eliminated. Eliminate eliminate from number one, inventory. Then number two, retained earnings of the selling company, selling company. You are going to subtract it from the retained earnings of the selling company, that unrealized profit, that UPS. You are going to eliminate it from inventory. Therefore, if I'm consolidating my inventory, and let me consolidate inventory because Waziri has just entered. Therefore, let me consolidate inventory. I take that of H plus S minus the UPS, the unrealized profit on closing stock. I subtract the unrealized profit on closing stock. Therefore, and in the retained earnings also, I subtract the unrealized profit on closing stock. In a question, examiner will tell you like this. In a question, listen, in a question. During the year, H Limited sold goods for Kenya shillings 500 million, making a profit margin of 25%. A half of the goods had not been was still in the inventory of S Limited. I repeat, examiner will ask you like this. During the year, H Limited sold goods worth shillings 500 million to S Limited, and H Limited sells goods at a profit margin of 25%. Half of the goods were still in the inventory of S. Therefore, we sold goods worth 500. We made a profit of 25%. Therefore, it means that the total profit was 125. That is 25% of 500. Then half of the goods were still in the inventory. I multiply by half. Therefore, the UPS will be 1, will be 6, 63.5, I think. 63.5, I think. That is the UPS. That is the UPS. Therefore, the UPS will be eliminated from the inventory and from the retained earnings of the selling company. That is about the UPS. That is about the UPS. Any question on the UPS? Daniel, any question, Daniel, on UPS?
It's
Daniel,
me who has a question.
Yes. Yes, ask your question.
Mwalimu, sorry, I had network issues. This unrealized profit, is it the parent selling to the associate or associate selling to the parent? We'll just do the computation that way.
Now, it depends. For example, if it is H, the parent and the subsidiary, it might be either way. For example, during the year, S Limited sold goods to P, to the parent. As long as goods were sold to a group member, it will give rise to UPS. As long as goods were sold to the group member, it will give rise. It can be S sold to H or H sold to S, whichever, it will give rise to UPS. Then we go to number 3. We call it fair value adjustment. Fair value adjustment number 3, we call it fair value adjustment. Now, in a fair value adjustment, this is where on the date of acquisition, when you are saying, and what figure do I report in the retained earnings? So you report the UPS. For example, the profit, let me say the profit of S is 500. The UPS is 50. Therefore, in the profit of S, you take 500 minus 50. Therefore, the profit will be 450. You less the UPS of the selling company. UPS of the retained earnings of the selling company. That's what Madam is saying. You less from the selling profit of the selling company. If S sold goods, it realized the profit. Therefore, if the profit of S is 500, you less, we get 450. If it is H that sold goods, we less from the profit of H, that UPS. Now, I was saying fair value adjustment. On the date of acquisition, for example, H Limited sold, on the date of acquisition, S Limited, that is the subsidiary, revalued its net assets. S Limited revalued its net assets. Because when I'm coming to acquire, like for example, you want to come to acquire NTC today, you want to buy shares in NTC. I will not just give you the assets the way they are. I will do the valuation of the asset. Therefore, I can value our laptops, I value our cameras. Then I find that our camera is from shillings 100,000 to 150,000. The value is 150. Therefore, I revalue. That's what we are going fair value adjustment. Fair value adjustment will give rise to what we call fair value will give rise to what we call revaluation. Revaluation. This will give rise to what we call revaluation. Fair value adjustment will give rise to what we call revaluation. Now, upon the revaluation of the assets, listen, follow up. Stay with me carefully. Upon the revaluation of these assets, the subsidiary may fail to incorporate that revaluation surplus in the books. May fail to incorporate the revaluation surplus in the books. For example, we have revalued our plant or PPE. It was 200 million. We have revalued by 50. Therefore, it comes to 250. But now, instead of reporting 250 as a subsidiary, I'm still reporting 200. I have not adjusted my net assets to 250. I'm still reporting what? 200. That's why Madam is saying, upon revaluation, the subsidiary may fail to incorporate the revaluation in the books. Now, if you fail to incorporate the revaluation, then it means you are understating the assets. How are you understating the assets? Instead of you reporting 250, you are reporting 200. Therefore, you are understating the assets. You are understating what? The assets. Therefore, it means we are going to reinstate the assets, revaluation adjustments, revaluation adjustments. You are required to debit. PPE, that is the asset account. You debit, you credit revaluation reserve. You credit revaluation reserve. You debit PPE, you credit revaluation reserve. I'm saying upon the revaluation, you fail to incorporate revaluation in the books. Therefore, we are going to do what we call revaluation adjustment. Revaluation adjustment, you are going to debit PPE, then you credit revaluation reserve. You debit PPE, you credit revaluation reserve. Therefore, when I'm consolidating my PPE, I will take the PPE, let me consolidate PPE, I will take H plus S plus revaluation surplus. I'm going to incorporate revaluation. Then, this revaluation reserve account transfer the revaluation reserve to cost of control for goodwill purpose. Transfer the revaluation reserve to cost of control for goodwill purpose. Therefore, when I'm computing goodwill, listen very carefully. When I'm computing goodwill, I know our net assets. We mentioned the net assets, ordinary share capital, share premium, retained earnings. Therefore, I'm going also to include the revaluation that I made on the date of acquisition. I will include also the revaluation as part of the net asset because that revaluation is part of the net asset. Therefore, if I failed to incorporate revaluation in the books, therefore it means when I compute goodwill, that revaluation surplus, I'm going to add to the net assets. Then on my PPE, I'm going also to add the revaluation on my PPE. That is when to say debit PPE, credit revaluation reserve. If it was downwards, listen very carefully. If I revalued downwards, then it means I will subtract. If I revalued downwards, I will subtract. Even here, I will subtract if I revalued downwards. But if it was upwards, you add. If it is upwards, you add. Now, let me develop this concept again. That is revaluation adjustment. Now, if we did not include revaluation in the books, then it means that from the date of acquisition to the date of consolidation, we undercharged depreciation. There we have number 2 adjustment is depreciation adjustment. Depreciation adjustment. Number 2 is depreciation adjustment. Like for example, I said the asset was 200, I revalued by 50, therefore it's required to be 250. But for me, I'm reporting 200. I have not adjusted to 250. I'm reporting 200. What does it mean, my good friends? It means that when I was depreciating, I only depreciated 200. I did not depreciate the 50. I did not depreciate the 50. Therefore, I undercharged depreciation. I undercharged depreciation. Therefore, when depreciation was undercharged, it means that profit were understated. When you undercharge depreciation, you overstate the profits. And also when you undercharge depreciation, you overstate the asset. Therefore, it means that on consolidation, depreciation, I'm going to debit retained earnings, I credit asset. Upon consolidation, that depreciation adjustment, I'm going to subtract it from the retained earnings. That is what I'm saying, to subtract from the retained earnings, then I also subtract from the asset. Therefore, if I want to consolidate my PPE, I will take the PPE of H plus S minus R plus revaluation, then minus depreciation. On 50 alone, remember I revalued by 50. I have not charged depreciation on 50. Therefore, I'm going to subtract that depreciation in my PPE upon revaluation. And also in the retained earnings, I will subtract that depreciation because I overstated the profit. That is depreciation adjustment and revaluation adjustment if there is fair value adjustment. Now, examiner will tell you like this. I like giving examples. Examiner will tell you like this. On the date of acquisition, the identifiable net assets of the subsidiary were the same as the book values, except an item of land, which was shillings 40 million above its book value, which was shillings 40 million above its book value. Then the examiner reads that statement like that. I was saying an example. On the date of acquisition, the fair value of identifiable net assets of the subsidiary were the same as the book values, except an item of a plan which was shillings 40 million above the book value. Above the book value. Therefore, it means that we revalue the asset by 40 million. Therefore, if I revalue the asset by 40 million, it means I have not included in the books. Therefore, when I'm consolidating, I will take the PP of H plus S plus 40 million. I add 40 million. Then examiner told me maybe as a continuation that a plan had the remaining useful life of 10 years. It has the remaining useful life of 10 years. Therefore, it means that this plan will be depreciated at 10. Therefore, I have depreciation of 4. Therefore, when I'm consolidating, I will come to subtract 4. I come to subtract 4 there. I come to subtract 4 there. That is how we do that item. That is how we do that item. Then we go to another item. We have several items, but this one is the last. The last adjustment that we are discussing, the last adjustment that we are discussing is called number 4. Last adjustment is number 4 in the intercompany sale of fixed asset. 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 Now, when we talk of intercompany sale of fixed asset, this is where one group member will transfer an asset to another group member. This is where one group member will transfer an asset to another group member. Like, for example, H Limited has sold an asset to S Limited. H Limited has sold an asset to S Limited. We call it intercompany sale of fixed assets. Now, when companies transfer assets to another group member, it should not be seen as a resale. I just used the word resale. Resale. It should not be seen as a resale. It should not be seen as a resale. A resale means when I'm transferring the asset, I should not make any profit or any loss on that transfer. That is why Marim is saying it should not be seen as a resale. Therefore, I should not make any profit or any loss on that asset. If, for example, the cost of that asset was 200, I am required to transfer this to another group member at 200. Therefore, you will find scenarios where the parent transfers the asset at a price above, like you will transfer at 220. You transfer at 220. Therefore, it means you have made a profit. That profit, allow me to use the word illegal. That profit is illegal. It should not be there. That profit is illegal, meaning I should not make any profit or any loss. Therefore, if I sell at a profit, then I'm overstating the asset. I'm overstating the asset. Therefore, upon consolidation, that profit must be eliminated. When I'm consolidating, I will take PPE, H plus S minus profit that was realized minus profit that was realized. And also in the retained earnings, I will subtract, I will take the profit of hedge minus the profit I realized. I will take the retained earnings of hedge minus that profit. I eliminate from the profit because I do not make that profit. I believe up to there we are okay on intercompany sale of fixed asset. If it was at a profit, we eliminate that profit. If it was at a loss, we eliminate that loss. We eliminate the loss. We eliminate the loss. We eliminate the loss. Now, if we sold at a profit, listen, we are developing the concept. If we sold at a profit, then it means that the purchasing company overcharged depreciation. The purchasing company overcharged depreciation. Therefore, if we have intercompany sale, we shall have, that is the unrealized profit, This one we have said eliminate from PP and retained earnings. Then number two, we are going to have what we call depreciation overcharge. Number two, we are going to have what we call depreciation overcharge. Where will depreciation overcharge come from? For example, the cost of the asset was 200. I transferred this at 220. Therefore, I overstated the asset by 220. Therefore, if the useful life of the asset is 5 years, it means that we overcharged depreciation. That is 20 divided by 5. We overcharged by 4. We overcharged depreciation by 4. Therefore, depreciation overcharge will be added to the retained earnings. You also add it to the PPE. Will be added to the retained earnings. You also add it to the PPE. Because when you overcharge depreciation, you understate the PPE. You also understate the profits. That is all about balance sheet adjustments. That is all about balance sheet adjustment. It's question time now. Question time so that we move to the next segment. Question time so that we move to the next segment. Question time, Florence, kindly question time. It seems there is no question. Thank you very much. Therefore, those are some of the balance sheet adjustments that will be required to adjust before we do what? We consolidate. Therefore, when you are reading the question, these are the items that you will be looking for in a question. For example, in note number 1, note number 2, examiner is telling you that during the year, H Limited owed S Limited shillings 30 million. That is intercompany owings. We said you eliminate it from the receivable and from the payable. Number 2, examiner will tell you that during the year, H Limited or S Limited sold goods at a profit of 500 million. Half of the goods were still in the inventory. That is unrealized. You calculate what we call unrealized profit. Number 3, examiner will tell you that's fair value adjustment. On the date of acquisition, the fair value of the identifiable net assets of S Limited were the same as the book values, except an item of land. You just know that this fair value adjustment, I explained how you are going to handle that. Then number 4, examiner will tell you that during the year, H Limited sold an item of land to S Limited at a selling price of 200 million. H Limited sells goods at a profit margin of 20%. Then he keeps quiet. it means that we sold an item of land at a profit. Therefore, you are required to adjust before you consolidate. You adjust before you consolidate. Now, before we end the class, now we are done with the balance sheet. Before we end the class, let's look at the income statement. Let's quickly look at the income statement. So that on Friday, we do a comprehensive question on Friday. We shall be doing a comprehensive question on Friday. Therefore, let's quickly, because you told me that you don't have any question, now let us look at the income statement. Income statement, then we do the question on Friday. We do the question on Friday so that we move faster with this. Then let's discuss group income statement. Group profit, statement of profit or loss. Statement of profit or loss. Group statement of profit or loss. Group statement of profit or loss. Now, this one, I just want you to give you the format of how you prepare the group statement of profit or loss. Therefore, I say here, shillings. I just want to give you the format on how you prepare group statement of profit or loss. We begin with revenue. Revenue, you take the revenue of H plus the revenue of S minus intercompany sale of goods, intercompany sales. You less intercompany sale of goods. Intercompany sale of goods is where one group member sold goods to another group member. That is not a sale. We cannot count that as a sale because I just gave my brother. It's like you have a wife or a husband. You gave him some money. At the end of the year, you are putting all together your money. Then you say, my husband needs to pay me my money. Therefore, you are complicating things. That is, you don't say, just because, of course, at the end of the month, if I earn 10,000, you earn 10,000, we are putting together the money. Therefore, if, for example, during the month, you gave me some amount, then we cannot say that you owe, that you gave me money. Therefore, we take H plus S minus intercompany sales. Then we come and less cost of sales. Cost of sales is H plus S minus also intercompany sales. Minus intercompany sales because if I sold goods, then it means to me it was a sale, to S it was the cost of sale. Therefore we subtract because it was a sale. Then on the cost of sales I add depreciation, undercharge. I add depreciation, undercharge. I add depreciation, undercharge to the cost of sales. I add depreciation, undercharge. I also add an UPS on closing stock. On closing stock, now I believe you understand what is depreciation, undercharge, what is the UPS. Then you are going to add the cost of sales. Then you less depreciation overcharge. Depreciation overcharge on the cost of sale. That is how you get the cost of sale. Then you give me what we call the gross profit. Gross profit. You give me what we call the gross profit. Then I come to less expenses, I come to less expenses. Under expenses, I have administrative expenses, H plus S. Selling and distribution, H plus S. Impairment loss, current year only, current year. Impairment loss, current year. Impairment loss, current year. Then I get what we call profit from operations. I get what we call profit from operations. Then I come to less finance cost. This one I take finance cost of H plus S minus intercompany finance cost. Minus intercompany finance cost. Let me explain something on intercompany finance cost. Intercompany finance cost means H. Madam just mentioned H. Gave a loan to S that attracts interest. H gave a loan to S at an interest of 10%. Therefore, if there was a loan of interest, then it means that H, if H gave a loan to S, S is to pay that interest, Where will that interest go? It will go to H. Therefore, that is what we call intercompany finance cost. We don't consolidate intercompany finance cost, we subtract. Then I come to add investment income, H plus S minus intercompany incomes, minus intercompany incomes there. Then after that, I get profit before tax. After I get profit before tax, then I come to less taxation. H plus S, less taxation, H plus S. I come to this one with less taxation, H plus S. Then I add group share of profit after tax from associate or joint venture. I come to add group share of profit after tax from associate or joint venture. Now, let me explain this. In associate or joint venture, you don't consolidate associate or joint venture, even in the income statement. You will only take one item. That item is profit after tax from that company. In associate or joint venture, you don't consolidate. To consolidate means you don't add revenues, expenses, no. You only take one item that is profit after tax from that company. Then I come to add negative goodwill. Remember we said that negative goodwill is an income. Therefore, the parent will report it as income. That is why in the income statement, we include negative goodwill. That is income. Then I get profit after tax. I get profit after tax like that order. Profit after tax. After profit after tax, I come to less profit attributable to NCI. I come to less profit attributable to NCI. Then I get profit attributable to parent shareholders. Parent shareholders. SH is shareholders, parent shareholders. I get profit attributable to parent shareholders. That is how we prepare group income statement. That is how we prepare group income statement. Very straight. We are taking H plus S. In the revenue, we less intercompany sales. On the cost of sales, we less intercompany sale. We add depreciation under charge. We add UPS on closing stock. We less depreciation over charge. All those things I have explained, therefore they have no issue. When we come to administrative expense, we take H plus S, selling and distribution H plus S, impairment loss current year only, then finance cost, H plus S minus intercompany finance cost, minus intercompany finance cost. Minus intercompany finance cost. Then we are done with the income statement. Now, the only trick with the income statement, listen, this is very important. The only tricky part with the income statement is that revenues, expenses, you apportion them on time basis. That is very important, I repeat. Revenues, expenses, you apportion them on time. For example, I acquired the subsidiary in less than 12 months. Less 12 months. For example, I acquired this for maybe 6 months. 6 months only. Therefore, when I'm taking the revenues of S, I take 6 months. When I'm taking the cost of sales, I take 6 months. When I'm taking administrative expense, I take 6 months. When I'm taking distribution, I take 6 months. When I'm taking finance cost, I take 6 months. Therefore, in the income statement, you need to be very careful with how long did I hold this company. Now, because we have discussed these things, I want you to look at the assignment. September 2021, question 1. When we meet, I want to see the answer for that question. Now that we have discussed enough for today, thank you for your time. Thank you very much for coming. Let's meet on Friday. I will want to see that question, September 2021, question number 1, if you have already done it. Thank you. May the Lord keep you safe, sound, and secure. We meet on Friday, God willing. Thank you very much for your time.